Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have provided North Florida savers and investors sound, comprehensive financial guidance for over 25 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter, 7 years and running. GulfCoast Financial Services founder and CEO John Kuykendall is our resource each and every episode of the program to provide guidance and insight, hoping to help you uncomplicate the financial world and make the decisions that you face with your money a little simpler and easier to understand, and hopefully making a little more progress as a result. John, it certainly is an interesting time that we live in. The decisions we're facing with our money have not become less complicated recently, it seems.
Oh, no, Peter. I mean, with the market volatility that we're seeing, with inflation, with the lack of workers, supply, demand, there's just so many things out there that have affected the market that it's just hard to pick one. I mean, certainly the political situation is one that we have to look at. But, markets, downturns happen. And we've been blessed. I mean, we have really, truly been blessed for having an up market for a long time. And so Brent and I were talking the other day, there are a lot of advisors out there who haven't really seen volatility like this.
Yeah. Interesting that those that are sort of new to this industry or fresh in it have experienced a 12, 14-year run up in the market where we have not really seen any kind of true market correction or economic business cycle. Sure, we saw COVID. We saw a momentary kind of blink of an eye downturn at the end of 2018, but the last decade plus has been pretty easy on financial advisors across the board.
Oh, yeah. And the COVID thing was short-lived. While we went down, we came right back up. So it wasn't a prolonged event where, we had 3 or 4 or 5 months where we were really struggling. It was back up in the same month. So that was really different. And the small loss we took in 2018 was certainly nothing like you would see in a correction or as we have seen in a recession, Yeah.
Well, John, you've had a little longer experience in this industry. You've seen a few challenging times before and have helped clients through those times. And if we've got a plan that recognizes that the market will go up, yes, over time, but also will have times where there will be downturns, and that is part of the expected experience that we will have, we probably can keep a level head and make it through these times with a better result. And by making better progress, seizing on what opportunities may lie even in challenging times. And ladies and gentlemen, you always need to have that plan put together. That's been the overarching theme of this program, is to have a financial focus plan, to have a plan that helps you achieve and accomplish your goals. And whether you've got the tools out there but want to bring them together into a plan, or even have a plan already and want to review and evaluate it, or you would like to initiate that true plan for your financial future, pick up the phone. You've got a resource available to you, and the team from GulfCoast Financial Services and John Kuykendall make available the time on a complimentary, no cost, no obligation basis. Simply get in touch. Quick phone call, 386-755-9018, 386-755-9018. John, the reality is that down markets do happen. They often are more sizable than most of us would like to really think about, and more frequent than most of us really understand. But we've got to have that and keep that in mind as we are formulating our plan, and therefore can probably make better decisions about what actions to take as we see them or make our way through them.
Well, that's right, Peter. I mean, we can't expect that old myth that says the stock market's going to make 10, 12%. It will over time, or has over time, but it doesn't do it consistently. And if you're saving for retirement, you need to continue to invest, continue to be in the market. If you're pulling money out for retirement, then as you know, with that sequence of return problem where we're pulling money out in a down market, we might want to be a little more conservative than what I would be if I was just investing for the future and I had 10, 15, 20 years to retirement. But the market will go down. It does correct. But it's kind of like we used to say, we got to clean the forest in order for the trees to grow. We have to have that fire. And so we have that fire, and then the market continues. And that's really what we've seen over the last, the last 13, 14 years. We've had these little blips, but they weren't as big as what we're seeing right now, or wasn't as often as what we're seeing right now. And we didn't have all the political and supply ramifications, everything else outside of the market that's causing us to worry. But, the average growth of the S&P over a 15-year period from 96 to 2001 was only 5%. But still, your money's going to double every 14, 15 years, 14 and a half, something like that. So if you're in the market and we don't have to make 10% to have enough for retirement. We just have to be consistent.
I've seen these risk profile questionnaires and in fact filled several of them out. And there's always some question, well, if the market is to lose 25%, what is your response? And the options are immediately move to cash, immediately move to strategies that are more conservative, wait it out, kind of just wait and see, move to strategies that are more aggressive, or add cash during that kind of downturn. My question here, John, is there a right approach to experiencing market volatility and downturns?
Well, as I said earlier, with the sequence of return, I don't think so. I think if we're a young investor and we're adding money cash to the market, then we're doing dollar cost averaging. We're going to be buying at lower rates. We're going to kind of blend out our returns. And so we're going to do all right. If we're a retiree and we're pulling out, we should certainly be more conservative and then be more aggressive later when the market corrects. If I'm a long-term investor, I need to stay invested. No matter what happens, the market will come back. The worst thing we can try to do is time the market. There is no one out there, I don't care what kind of program they've got, that can time the market.
Not effectively. So the question then, therefore, John, not will we experience a market downturn in the future, but maybe more importantly, what will I do with my money if and when we experience that downturn? We really need to kind of be reflective, self-reflective, and examine what is our answer to that question.
Well, that's right, Peter. And, I've always said that we have to have a risk tolerance number that allows us to sleep at night. We don't want to be so aggressive that every time the market moves, I'm going to be trying to move my portfolio. But on the other hand, we want to have a risk number that gives us the returns that we need for retirement, but at the same time gives me some cushion. When I'm retired, I'm paying myself. And if what I'm paying myself out of is going down, then my money's going to run out sooner than if I hadn't taken any out. So we have to have different buckets. And that's what that bucket of the income plan does. It allows us to have buckets, income that we guaranteed every month that we know we're going to get. We know we're going to have that income coming in, Social Security, and then we're going to augment it with an annuity or life insurance, some other kind of income that I can count on in downturns so that I don't have to pull as much money out of my investments. But without that income plan, I'm flying blind. And it's kind of like going to the mechanic and saying, hey, I got a tweak, and expecting him to find a tweak when you don't know where it is. And that's what you're doing if you don't have that income plan.
Well, again, that income plan, a vital component to a comprehensive financial plan. It is one of the pieces that brings that all together. And unfortunately, it's a piece that a lot of plans seem to be missing. So to complete that plan, to bring all the pieces together, you need to specifically find out how to structure, design, and get in writing a financially focused written retirement income plan. And you are, of course, welcome to call GulfCoast Financial Services. John and his team there put those together for their clients on a regular basis and can help you with that. To structure that written retirement income plan, give a call 386-755-9018. That's 386-755-9018. There's a big difference, John, in what we see from projections and what that kind of written plan entails. For instance, you gave the statistics on the reality of the market for the 11 different complete 15-year periods from 1996 all the way up through the end of 2001. Every complete 15-year period, the average cumulative compound returns for all of those 11 15-year periods, only 5.03%. That's the reality of it. Whereas a lot of plans are based on the expectation that we will make some consistent 8, 9, 10, 12% rate of return. That's the difference between a projection and a plan. And what that difference means, if you're relying on one or the other, could be rather substantial.
Oh yeah, Peter. I mean, we're going to run out of money if we rely on these projections. There's no way that this market is going to give us a 10% return consistently. You know, when you're talking a bear market, which is a loss of 20% or more, over the last 100 years, there have been 16 bear markets, one every 6.25 years. Now, the good Lord has blessed us during this since 2008 that we haven't had that. But we've had one of these in history every 6.25 years with the average loss of minus 39%. So, you know, that's a lot of money. I can't lose 40% of my portfolio and then still pull out my 5, 6, 7, 8%, go on my trips, do all the things that I want to do. My go-go years are going to be my no-go years real quick. And so I have to have that plan. And, you know, Peter, the thing I have to tell you is, as you know, because you are also, we're fiduciaries. We have to put the client's interest first by state law. I mean, I'm a state registered investment advisor. I have to put the client's interest first. It's not about products. It's not about what we can sell you. It's about what's best for you and your retirement. And that's what we really try to do here at GulfCoast, is make sure that everybody has the kind of retirement that they want, they expect, and they deserve. And without that income plan, I'm telling you, you're just flying blind.
Well, there are a lot of projections that have certain assumptions that they are based upon, and your results are only as good as those assumptions are reliable. So, John, separating out a little bit of the fact versus fiction or the myth versus reality, a lot of plans are based on the fact that bear markets are actually very rare, that they seldom occur, and that if they do occur, they snap back very quickly to almost amount to an unnoticeable event. The reality, you just stated it, in the last 100 years, there have been 16 different bear markets. Now, a bear market defined is a loss of 20% or more in the market index. So that's 1/5 of our life savings, if we are invested, that on 16 different occasions has evaporated without us having anything to show for it. If we don't have a plan that reflects that as not only a possibility, but a reality that we are likely to face several times throughout retirement, then that plan probably is not based on sound assumptions.
No, Peter, and you know as well as I do that looking back at the life insurance policies that were sold in the 70s and 80s, they were using, I didn't sell them back then, but they were using 10% assumptions for a universal life policy. And you know, as I know, how many of those things, how many people have come to you and said, hey, they're telling me now I've got to increase my premium because my policy's running out. It didn't make the money or show the gain that they were projected because they used the wrong assumptions. And we can't do that with an income plan. We need to make sure that we're conservative, that we use the right assumptions, and that the numbers are realistic. There's no sense in telling you that you're going to make 10%. You're not going to do it. I would love to do that. I mean, my money would double every 7.2 years, and I've probably got that. So that's great.
but counting on that consistently is not the foundation for realistic expectations nor financial certainty in the future.
No, and that's what happened, like I said, with those universal life policies. And that's what's happening with a lot of plans. They use these assumptions that aren't right to make the plan look really good. And, that was what we did back when we didn't really understand financial planning. We didn't have the software or the tools. We would put numbers in that would give you this huge leftover legacy. You're going to give $4 million away to charity and all this. We're right now just saying, hey, if I can get you at break even when you die, I'm happy. And that's what we try to do.
Again, we are talking with John Kuykendall, founder there at GulfCoast Financial Services. If you've got questions, if you'd like to get that plan put together, if you'd like to examine your current plan and the assumptions that it projects and is based on to make sure that you are comfortable relying on those for your financial confidence and stability into the future, pick up the phone and give them a call. They'll run through a detailed forensic financial analysis and help you uncover those assumptions and then talk them through with you. Are they reliable? Are they realistic? Or do we need to reassess in certain areas? Now, certainly, we want to do that as early as possible. Be aware if there are things that we may need to re-examine. You're welcome to give them a call for a complimentary review, a retirement planning and financial focus strategy session, 386-755-9018. That's 386-755-9018. John, the duration of these bear markets is sometimes surprising as well. I mean, I think we suffer from recency bias here. The COVID downturn, it was almost back before people even opened their statements to see that they had even lost money in their accounts at the onset of COVID. Most bear markets don't happen that quickly. In fact, a lot of them are sort of a slow bleed over the period of multiple months or even a year or more than a year. And you wake up one day and I'm down 2%. You wake up the next day, I'm down another 2%. And then before it's all over, we're down 20, 25, 30%. And we say, oh, we've got to do something about this. And that's what's going to lead to making a reaction, a response that may not be in our best interest.
Well, that's true, Peter. The COVID downturn was a V. It went straight down and it came straight back up. And I honestly, a lot of the people who are investing haven't really been in a bear market. What we've done is because we've had this period of time where everything was rosy. I mean, we've made money every year except 18 and since 08, except for 18. And so you can't look at that V and say, oh, I was in a bear market. You weren't. You were in a V that came right back up. Before you had time to open your statement, you were almost back to break even. But if you look at that chart, you'll see that was a prolonged straight down, straight up. Bear markets aren't that way. They're down and long time and then come back up. So when bear markets happen, and we even 2008, that was a real estate bear market that caused the country to go into a decline. Almost a recession, but it wasn't. And that was because that real estate market was so overbought, so overbuilt that when that crashed, everything came down with it. But when we see companies not making money, companies not earning, and we see the stock market slowly going off because inflation's up, loan rates are up, borrowing's up, you're going to see a whole different bear market. You better be ready for it because, like I said, we haven't experienced it in a long time.
The housing market sounds eerily familiar, John. just side comment there. But bottom line, we've got to have a plan that includes the reality of the frequency and the magnitude of potential market losses. And we'd all love to ride a market that has an unending uptrend that is just continually up every year. And for the better part of the last decade, that's actually what we've experienced. But if we don't have a plan in place that also includes the possibility and the likely reality that we'll face headwinds from time to time, then we may be setting ourselves up to not achieve our expectations. And that's what we've been talking about a little bit on today's program within the context of what we see going on in the world around us. John, I think that more and more people are becoming aware of this and concerned if their plan does not account for the potential of market downturns.
Well, I think you're right, Peter. I think that people are beginning to get concerned. Certainly, with all the knowledge and all the computer knowledge that we have now, we're seeing things in a whole different light. And like I talked to you, just that sequence of return risk, that's a huge factor for retirees because I'm pulling money out in the down market. I know my money's not going to last as long. We have to be proactive. We can't, it's just like with our taxes. We need to be proactive, not reactive with our financial planning, our income planning. We need to be proactive and we need to have our money in more than one bucket. We can't rely on our investments to get us through every month, every year. There has to be some way that we can give them a break from time to time and pull money out of another bucket. And that's what the income plan does for us. We take that, we use conservative returns. I mean, our returns that we're showing for the market are someplace between 4 and 6%. I can't use a 10% number and be realistic. To me, it just doesn't work.
And over what time period are you talking about there? I don't know.
30 years.
30 years. Okay.
Yeah.
And by projecting that out, we are able to, over a similar 30-year period into the future, have a much more realistic expectation of what we should see and the progress that we should make.
There are going to be some years that I'm going to make 15, 20%. There are going to be some years I'm going to lose 10 or 15%. But overall, if I can average 5, 6% over my lifetime, I'm going to have a good retirement.
When you spoke about the buckets and the choice of where to place our money, here's another kind of separation of fact and fiction or myth and reality with the market. We have all heard the phrase, past performance is never a guarantee or a good indicator of future results. But John, is past performance even a true and accurate indicator of past results?
Well, I guess there's a lot of discussion on that. I don't really believe so, because every year if you look at the different sectors, a different sector will be on top. Next year, it may be on the bottom. Next year, it may be on the middle. So I can't look and say, well, that fund has made 15% over the past 5 years and say that it's going to make 15 for the next 5. I don't know what it's going to make. It depends on the fund manager, how long he's been there, what he's investing in. If he or she takes a real huge risk and bets on a particular segment like Bitcoins or something else and it goes south, there's a lot a lot of input in there. So I'm not really relying on past performance. I don't think anybody should.
Well, talking today about the expectation for good markets and bad markets to be included in a sound, comprehensive plan. The fact of the matter is we will likely experience both over our investment lifespan and experience. And the plan should address that we will move through both and fundamentally show us the way that we can make it through so that we can stick to that plan, good times or bad. The market is a fantastic tool, and if used for the right reasons at the right times, we can have reasonable expectations. Unfortunately, John, we just see a lot of people whose projections don't lead them to reasonable expectations and don't prepare them to make sound financial decisions during challenging times.
Well, that's right. And they can't, you can't rely on the market to do it year in, year out. You've got to have other sources of income, other sources of investment. You got to be diversified. You got to have a good risk number. All those things go into effect. And so you can't just say, hey, I'm going to throw my money in this fund. It's got a great track record and go on. It won't. Those days are over.
Well, again, if you would like to get a financially focused plan for your future, written retirement income plan, included with that. Pick up the phone and give Gulf Coast Financial Services a call, 386-755-9018, 386-755-9018. If you've got some concern with where the market is heading, if you are a little nervous about instability and want to review and double check your current plan, they offer the opportunity for that complimentary review, a discussion of your plan, digging beneath the surface, a forensic financial analysis and strategy session to help you examine the assumptions that your plan is based on and see where there may be opportunities for improvement and even opportunities in challenging markets. Give a call, 386-755-9018. That's 386-755-9018. John, I'm sure it's not the last time that you and I will have a discussion about market headwinds and potential for volatility, and it's certainly not something that should be ignored in the planning process.
I think there are going to be several occasions this year, Peter, to talk about that.
Well, if you would like to have an individual conversation about it, pick up the phone, give John and his team at Gulf Coast Financial Services a call, 386-755-9018. We'll talk to you next time on Financial Focus.
Thank you, Peter.
Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services Inc., a registered investment advisor in Florida. Gulf Coast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.